Gold didn't just spike, it just $54 on war fears, then collapsed sharply below 5,000. Why does this happen? Even though the US-Iran conflict is still escalating? Let's find out now. Hello traders, welcome back to Nova channel, and let's continue another new topic today. Gold recently surged toward $54 per ounce after a major military escalation involving the United States, Israel, and Iran. Reports of coordinated strikes and the death of Iran's supreme leader caused panic across market, driving investors into traditional safe havens like gold. But just as fast, prices reversed and fell back, eventually slipping below $5,000. This reversal surprising many traders because geopolitical conflict usually supports bullion prices. So what changed? Why did gold not stay high and even crash dramatically despite ongoing war risk? The first reason we need to talk about is the safe haven spike, massive, temporary, and reactive. The initial move above $54 was driven by panic buying. When geopolitical tension exploded, markets rotate out risky assets and into assets perceived as safe. Gold safe haven status often triggers this rotation immediately, sometimes before the economic fundamental change. Investors also reacted to fear that the Iran conflict would disrupt global energy supplies, especially after reports that key shipping routes like Strait of Hormuz were targeted, which could impact oil flows and inflation. This kind of move is fear-driven, not trend-driven. It's fueled by headlines, not by sustainable buying pressure. And let's find out what pushed gold back down. The first reason is investors grabbed profits quickly. After gold spike, many traders liquidated positions to secure gains, especially speculative traders who bought the breakout. This selling pressure caused price to pull back sharply. The second reason we need to talk about is liquidity needs for selling. When markets experience turmoil, investors sometimes sell safe havens to raise cash and over losses or margin into other assets like stock and bonds. In recent sessions, investors withdrew large amounts of equity and pure cash into money market funds, prioritizing liquidity over holding gold. And the next reason is the US dollar strengthened. A stronger US dollar usually puts downward pressure on gold because dollar-denominated assets become more expensive for holders of other currencies. During the sell-off, the DXY index rallies, acting the ultimate safe haven instead of gold itself. And the last reason, rate expectations shifted. Surging oil and inflation risk change expectations about interest rates. Higher yields and reduced expectation for rate cuts can weaken gold because gold offers no yield. With rising bond yields and stronger dollar, investors reduce weighted exposure to gold. These forces combine to overwhelm the safe haven demand that initially lifted gold to $54. And the next part of today's topic, let's find out what it means for the gold market. Gold's behavior in this conflict reveals an important truth. Safe haven demand can be powerful but volatile and short-lived. The initial spike was a reaction to fear. The subsequent collapse was a reaction to shift priority as the markets balance liquidity, mix with risk and use dynamics. This kind of price action is typically in geopolitical uncertainty. First, fear spike and bids. Then, traders lock in profits. Next, the dollar and yields exert pressure. And finally, safe haven flow once its market risk assessment shifts. As the result, gold does not always remain at its peak after a conflict shock, especially when macroeconomic factors like dollar and interest rates compete with safe haven demand. For scalpers and short-term traders, this setup highlights a key lesson. Gold react to wars is not always linear. A spike does not guarantee continuation. A collapse does not mean the trend is broken. Instead, traders should watch key technical zones. Psychological levels like 5,000 can flip between support and resistance rapidly. The next one, macro drivers. Relationships between gold, the dollar, and yields matters as much as headlines. You also pay attention to liquidity flows. Sometimes gold are lost because investors need cash elsewhere. And lastly, risk sentiment rotations is also very important in this case. Markets can move from gold to dollar to bonds is responsive to evolving conditions. In conclusion, gold's buy above 5400 was real, but it was born from fear, not structural trend. The fall back below 5000 wasn't a betrayal of gold as a safe haven. It was a reflection of how markets balance conflicting drivers in times of crisis. When headlines dominate, the first move is emotional. The second move, where prices make real structure, is where smart trader finds the edge. And that is the topic today. Thank you so much for your watching, and don't forget to like and subscribe Nova channel to receive more useful video for your trading journey. Happy trading and see you in the next video.